Okay, hello everyone. In this chapter, we are going to discuss important topic, the cost of the capital. So whether a company is expanding, investing in their new technology, or making strategic financial decisions, the cost of the capital can be the determining the factors. So we discussed how firm value is determined by three components: size, timing, and risk, right? In addition, this size is actually amount of expected cash flow. The key to valuation is actually weighted average cost of capital, WACC, which we will discuss in this chapter. WACC is the discount rate that help estimate the firm's intrinsic value. So why the cost of capital such a big deal? So business need capital to develop their new products or build a factory, expand internationally, even acquire other firms. Before making these investments, firm must evaluate whether their expected return higher compared to the cost of obtaining this capital. So this concept also play a role in compensation plan, as executive bonus often depends on whether the firm's return on invested capital exceed its cost of capital. Additionally, it influences the financing strategy. One must decide how much debt versus equity to use and whether leasing might be better option than buying. So all related factors actually will be determined by the concept of weighted average cost of capital. So the value of the company's operation, actually this is based on present value of its expected free cash flow and discounted at a weighted average of cost of capital WACC. So this can be expressed mathematically as you can see the top equation, right? So VOP is operating part the value equal the in the future is expected FCF and divided by its discount rate, but however, this discount rate is WACC, so 1 plus WACC at the time t. So all this part is we represent the present value of FCF and add them up. So this is expected corporations, yes, corporation companies, operations value. So essentially, this means that firm's wealth is determined by future cash flow and then adjusted by time value of the money and risk, right? So what is the WACC? So WACC is the average rate of return the firm must pay to all its investors, whether they provide the capital through debt and preferred stock or common equity. So the formula for the WACC is, you can see the second green part. So WACC equal RD times 1 minus tax rate times weight of debt WD and plus R STD. STD is the short-term debt and times 1 minus tax and weight of short-term debt WSTD plus preferred stock return R PS and times preferred stock weight WPS plus RS. S means just common stock and WS is weight of the common stock. So in this equation, RD represents required return on long-term debt. So this is the coupon rate on new debt or YTM on existing debt, where T represents the firm's effective marginal tax rate. RST is required return on short-term debt. So usually this is equal to the interest rate on the debt. So RPS is required return on preferred stock. So RS is required rate of return in common stock. So WD, WSTD, WPS, and WS. This is all weights of long-term debt, short-term debt, preferred stock, and common stock in firm capital structure. This is usually based on the market value. So now let's consider whether firms get their capital. Businesses rely on different sources of investors' supplied capital also called capital components. So why some firms use short-term debt and preferred stock? This is two primary sources of funding for most companies are long-term debt and common equity. So investors providing these capitals expect a return that match the risk level of their investment. So from investors' perspective, these are return. But from the firm's perspective, these are cost of capital. So that is why we call WACC, is the cost of capital. Since interest expense on debt are tax deductible. So after-tax cost of debt is lower than its actual required return, which is why we adjusted for in tax part is 1 minus tax in WACC formula. Okay, so in this slide, we will break down the difference between market and book value and explore investors' applied capital and discuss how firms determine their ideal capital structure. So understanding this concept is crucial for making just financial decisions. Okay, first, let's distinguish between market value and book value. So these terms are often used interchangeably, but they mean different things in finance. Okay, notes payable in balance sheet. Typically, this is match their book value since they are short-term obligation. However, long-term bonds, this is long-term debt, right? So long-term bonds may have a market value. It's different from the book value due to discounts or premium based on interest rate changes in market. For common or preferred stock, so market value depends on the share price in market and the number of outstanding shares, so which can fluctuate daily. So for evaluation and financial decision making, companies often rely on market value rather than book value, as market value reflects current investors' expectation and economic condition. So let's talk about investors' applied capital. The funds provided by investors to support the business operation is investors' applied capital. So this includes the first interest-bearing debt, usually loans and bonds that require interest payment. And the other is preferred stock. Preferred stock is a hybrid financing with a fixed dividend. And common equity, this is provide capital raised from shareholders. However, not all liabilities are considered investors' applied capital. For example, in balance sheet, in the liability, especially the current liability part, you can see account payable and accruals, so which is not the debt because it arises from day-to-day operation. This is not considered the source of the financing, but rather than short-term obligation. This is more related to day-to-day operation and their activities. So how the firm decide how much debt or preferred stock and equity to use. So that's whether capital structure weighting comes in. So there is 3 main approach. First approach is book value weight. This is actually based on historical financing decision record, usually use financial statements. So these may not reflect in current market condition. And second approach is market value weight. However, this market value weight fluctuates with the stock price, while more reflective of current condition, but they can be very volatile. So it sometimes makes them less ideal for long-term planning because they have a high volatility. And target capital structure. So target capital structure is a strategic mix of debt and equity designed to minimize WACC. Minimize WACC means so WACC is discount rate for the value of the firm, right? So if we minimize WACC, it generated maximize value of the firm, maximize present value of free cash flow. So it provides stable financing for the firm. So this is what firm aim for in the long run.